Once again, welcome everybody back to the Financing Simplified Podcast, brought to you by InTouch Mortgage Solutions. And today we're bringing back Claudio Venuto. Not only is he my brother, but he's also an agent with us. Claudio, tell us a little bit about what you do here at InTouch.
Hey, Ann, thanks for having me back on. So at InTouch, my job really is a mortgage underwriter. So my knowledge is structuring the deal, putting together all the documents, and knowing which lender to send it to that's best going to fit the client.
That's awesome. No, it's definitely, especially in this day and age with everything happening, interest rates going up, a lot of conversations around what's happening with interest rates, what's the Bank of Canada is going to do on September 6th. I know I've probably put myself out there. I'm in the camp where I think the Bank of Canada is most likely going to take a step back, hit that pause button, at least for the month of September. What are your thoughts on that?
I really hope you're right, but I don't know. Bank of Canada these days aren't, can't be too reliable. I don't know if I should be saying that, but I have a feeling we're in for another rate hike just because inflation's up. And, even though core inflation, costs of fuel, costs of groceries have gone up, Bank of Canada doesn't see it that way. So we'll see what we have in store.
Well, what do you say? How much do you think it's going to go up?
Well, I don't think they can go too crazy, but I think maybe another quarter point will go up.
I will say this. I think there's another quarter point in there at some point by the end of the year, at the back end of this year. I think we're going to see that. It all depends on what happens next. Remember, for our viewers, I said, like right now we saw inflation prop up from 2.8 to 3.3 because of base effects, basically year-over-year changes comparable to the same data point last year. And as we see these numbers sort of change, that's what the Bank of Canada was talking about when they said that interest rates were going to be, or the inflation was going to get sticky. We're definitely hearing from the U.S. Fed that obviously that interest rates are going to be higher for longer. And I think that's sort of the play. I get a lot of flack for, the way I think about it, but the Bank of Canada has a very pivotal role. They have put their foot on the ground. Yes, they've made critical mistakes over the last little while, to say the least, when they were talking about interest rates remaining low forever, or at least for the short period of time. Yeah. And then obviously they missed the, transitory mark. And, I will say this, if 400 PhDs that work for the U.S. Fed and how many that work for the Bank of Canada can't get it right, like, it's almost challenging. There'd be people out there that say, "Oh, well, I knew it." Like, bullshit. I call bullshit on that. I say, realistically, there's two ways to look at it. Obviously, the Bank of Canada has a very powerful position. I think they're going to usually, at this point, use their language to sort of talk people out of spending. But obviously, we'll see what happens on September 6th. I think that's really the key. But with interest rates going up ahead of that September 6th announcement, we saw bond yields, just picking up steam. And obviously that has a direct correlation to how fixed rate mortgages are priced. And, what we're seeing some crazy interest rates right now. Like, what are you seeing on the board right now?
Yeah, no, interest rates, especially on the fixed side, have definitely increased. And I think it's just keeping a lot of people off the table when it comes to purchasing and refinancing. A lot of people are just too scared. I know we're seeing rates over 6% on the 5-year fixed. 3-year fixed. It's there's not many options out there, and all banks are kind of on the same playing field right now, and they've kind of held back. I think they're just following Bank of Canada, trying to scare people off of making, purchases or taking equity out of their homes.
Yeah, that's exactly what monetary policy wants to do, right? They want to limit the amount of money, the cost to borrow being very expensive, so that people don't leverage and actually introduce this extra money into the economy. Last time I checked, I think was the only rate with a 5 in front of it is the insurable. Yeah. Everything else has a 6 or a 7 in front of it right now, which is pretty scary if you think about the cost of borrowing for a lot of these clients. And it's starting to happen. I mean, I guess with the Bank of Canada's most recent June-July hike, a lot of the banks with OSFI, the Office of the Superintendent of Financial Institutions, putting a significant amount of pressure, I think, on TD, CIBC, some of these lenders, to really get out to their client base and sort of say, hey, you have some options, but you need to exercise them. Putting in the lump sum payment, locking into that fixed rate mortgage. Yeah. A lot of Canadians that were not at that trigger point are now definitely, getting those notices with the pressure from OSFI. And I guess it brings us to, like, how do people manage, right? Like, I mean, we've heard those stories. You've seen the headlines. People's mortgage payments going from like $2,000 to $5,000 a month. And obviously what it means for people. Like, what are you seeing on that end?
You know what, it's for a lot, it's a disaster. For some that we're budgeting that $2,000 to $2,500 mortgage payment, and now seeing it double on a fixed salary. Maybe they have a growing family, maybe they've had to pick up a second job. Like, we've had clients and we've heard some horror stories where people are actually thinking about selling their homes. And as much as the Bank of Canada did what they did, I think they have to kind of stand accountable for some of their actions of what they're doing to Canadians.
Well, we do two-part on this one. I mean, you were going exactly where I was thinking with this conversation when it comes to renewals. And there's a lot of noise out in the media right now. Obviously, it's important to understand, like, and I said, don't quote me on the statistics, around 69% of Canadians own homes. I think 38 to 40% of them have mortgages. Obviously, it's when they got the mortgage, what their payments will look like. Let's call a spade a spade. If you have a variable rate mortgage with an adjustable payment, it's hurting right now. A lot of Canadians who are in that boat. If you have a mortgage with a trigger rate, obviously you're going to be triggered now to increase your payments. It's like we were talking with Mark earlier in the when we did our podcast. He was saying off camera, it's a lot for Canadians to budget. It's as you were saying, contemplating selling that home.
Definitely, because you know what, you're even seeing there's some clients that are on a static payment, and there's some that are on adjustable variable rate variable rate mortgage. Some like most Scotiabank mortgages are adjustable, so their payment adjusts every time the Bank of Canada or the prime rate increases, right? So at least they're still paying a little bit of principal down. And these people that are on a static payment, they're seeing their amortizations jump over 40, almost 50 years on their mortgage. 90, yeah. So it's a little bit crazy what we're seeing. You're definitely, in my time as a mortgage broker, this is a first for me. So it's a big learning curve.
And I think that was what we were talking about. A lot of the younger buyers right now in the marketplace have never experienced these types of environmental conditions. For most people, from when we got into the real estate market, when we first purchased our first home, it's been pretty much a bull market for the last, 15, 20 years. Some people argue less, some will argue more. But, I mean, we haven't really seen home prices come down. Arguably, since Justin Trudeau got into power, right? Since 2015, we haven't seen home prices come down. And just speaking of the political thing, I think this is a really big conversation right now, is the onus on the federal government and their stake in housing. He just came out not too long ago saying that, it's housing's not their primary responsibility. I'm like, excuse me, like, wasn't that your election promise in 2015? Was that you were going to make housing affordable? Now you're walking it back. I mean, look, as I said, I'm not playing party politics here, but I think housing is this bipartisan issue. No matter what side of the aisle that you're on, we need to create affordable housing. And now they're meeting in PI for a retreat. All these cabinet guys and girls and women, whatever the case is, to discuss what they're going to do with housing, because we have immigration at the highest level we've ever seen since, I think, the 70s. Housing starts at the lowest they've ever been. No builders' sentiment is down, so they don't want to build in an environment where people aren't qualifying for a house. It's like, okay, interest rates are high. What incentive do they have to build? And, the government's response so far is like, we have students that are coming in, 850,000, foreign students. First and foremost, I want to just get this out of the way, is think about foreign students that are coming here. That's the easiest path for them to become Canadian citizens or permanent residents, is because they come through education, 4 years, and then they can apply to become permanent.
Yeah.
And the problem is that universities are capitalizing on these situations because of the fact that foreign students pay more for tuition than someone who's from Canada.
It's definitely a big revenue stream for the universities.
Right. And now think about this. Universities have no obligation to create student housing.
No.
Right? So now you go to school, it's like, okay, now these students have to go into the cities, into the centers and rent, taking out existing rental, and the government saying, okay, what we're going to do, chop 10% off. But tying it back into the financing industry, how hard is it to do a student rental?
Yeah, there's barely no lenders that touch student rentals. And it's a very gray area, and let's just say, there's no top 8 banks that will openly say they do student rentals.
Well, that's the thing. It's like the lenders are getting really smart. They know exactly what condo units are designed for student rentals. They know how the proximity to the school. So, the only way to finance some of these units, you used to be able to get it done through some of the major banks, but now they're walking away. Privatized private mortgages. Some of these other lenders will consider it, but at a higher premium. And I really think if this is the case, we need to sort of bring investors sort of back to the market. I know people are going to probably say, Ant, what are you talking about, bring investors back to the market? And I'm like, if people can't afford to buy homes, but there's investors that can, and who can introduce inventory into the market to satisfy the need, I'm not saying that we should be rewarding these individuals, but at least making it a little bit more simplistic for them to be able to get into the industry, or to get back into the investment cycle, so that they can bring back this inventory, build purpose-built rentals. We haven't built purpose-built rentals for the longest time.
So
Yeah.
let me jump in on one thing. One of the big things that's happening right now in the market is a lot of people have equity in their home, and they're pulling it out not to invest anywhere, but to use it to pay their mortgage. What do you say about those people who are doing that?
That's the thing you want to touch on. I was just going to say, I mean, there are strategies where, especially with the rates the way they are, where in order to budget, for certain individuals, it could be a smart move because they can set aside their mortgage payments, let's say for a year and a half, and not have to worry about it, right? Yes, they're tapping into their equity. They might have to take a higher interest rate on their mortgage, but for them, it's a peace of mind where they know they can take their income and budget it towards other things, their children's education, just supporting their family on a regular day basis with the cost of groceries and living expenses going through the roof. It can work. It definitely can be a tool in people's tool chest.
I agree, Ant. What about you?
Listen, I believe a lot of Canadians are going to do whatever's necessary to stay in their homes. If using their line of credits or credit facilities to do so are the only means that they have, obviously they're kicking the can down the road. Let's not sugarcoat let's not sugarcoat the facts. It is what it is when people are going to be leveraging. A lot of clients are using their line of credits to make up or top up those payments if they have them.
Yeah.
Home equity lines of credits are a big problem, not problem, but they're a good product, but they're going to have a problem qualifying for them in this environment now.
Yeah.
And especially,
Not
depending on
necessarily. They have the collateral of their home.
yes, but they got to qualify for it, right? You still have to qualify for, if you don't have a home equity line of credit, unless you have a certain product with a lender that gives you the openness to get access to those funds, you need to qualify for that particular line of credit with that institution.
It definitely can get messy, especially if you have a higher collateral charge on your current mortgage with a lender that might it might hinder your ability to actually refinance your home.
And then working with equity lenders, the cost to borrow is going to be much more expensive, although it's cheaper than a credit card. We're seeing people do that. I mean, there's reports from Equifax that people are missing credit card payments, but they're still making their mortgage payments. And I think,
And I definitely think like that's one area where I feel like it's so, controversial because we talk about, we're kind of handicapping homeowners and with their mortgage and their interest rate, but credit card companies can charge 20% interest with minimum payment of $10. And we're seeing it now more than ever where people are racking up $50 to $100,000 of credit card debt, and like there's 50 to 100,000
Oh, yeah.
of credit card debt, unsecured debt.
How do they even get that much credit to begin
Because it's easy. Like that's one area where
$20,000 credit
Yeah,
cards.
you can easily
about
qualify for a credit card, and people are getting punished to try qualifying to buy a home. But banks are issuing credit cards.
for the rest of your life like that?
Definitely,
And
Espe-
bad debt, that's
bad debt, especially if you're not a homeowner, right? We see young people getting into even debt from education, OSAP loans, credit card debts, loan payments on their cars. These are things.
You're telling me some people can rack up over $50,000 in credit card debt?
Oh, easy, much or more. Yeah.
I mean, look, it's one thing to see it and one thing to understand, go through it. There's a lot of people that, and this always comes down to the conversations we're having, especially as we're working with a lot of first-time home buyers, is that conversation about, okay, you're buying a house, you're buying it together, you're newlyweds. What's the timeline for children? How does income look like if obviously one person goes off of work? What impact does that have to your bottom dollar, especially if you have a certain lifestyle, right? Is the lifestyle going to change? Is it going to remain the same? You're going to have diapers, food, and everything like these things that add into the cost, daycare, and one person might be off of work. So the income goes down, but the costs go up. And how do people compensate for that? Like, people don't think about that. And when you sort of pose that question to them, they take a step back and they're like, oh yeah, I never thought about like that. I'm like, yeah. So like
But that's because people are doing things to survive. survive and not thinking about the future implications that are going to come from it.
Yeah.
Think about it. For anyone that takes up more credit card debt and more people who go dip into their equity, they're basically in survival mode. They gotta find a way, a means to survive.
Yeah.
So what do you guys recommend they do instead of that?
Well, it's very challenging because I always tell people, like, when we do pre-approvals is here's the amount that you qualify for. Just because you can doesn't mean you should. Number one. Obviously looking at not throwing all your eggs in one basket, keeping some cash in hand, especially if you're a move-up buyer where you purchased, sold a home, made some money. You know, it's very tempting to throw all of it towards the house, but sometimes it's good to keep a little bit of money as a backup reserve fund so you're not dipping into credit cards at 20% or lines of credits at 8, 9, 10%. But obviously it's easier said than done for some. But I think it comes down to the cost of living, the crisis that we're facing here in Canada, or at least in Ontario. Canada, 3 major pockets: your Vancouver, your Toronto, GTA, and, you know, obviously some parts of Montreal, whatever the case may be. But there is affordable housing elsewhere in the country.
Yeah.
We were just in Calgary. I can tell you firsthand, it's relatively affordable. But nonetheless, when you think about when somebody qualifies for a transaction to purchase a home, we use GDS and TDS, so gross debt servicing ratios and total debt servicing ratios. And those numbers on someone who is salaried or hourly, it's gross. It's calculated on their gross. And they have a servicing ratio of 39% TDS and 44%, so on and so forth, yada, yada, yada. I'm not going to bore people with those. But that's pre-tax. What are they taking home after the fact? And I always say this. I said, you're looking at it from before you're taxed. So yeah, you make this on paper, but what are you really making? You make $100,000 when you take home.
Well, you're taking 50%.
Well, depending on how much with tax bracket you're
Yeah.
in. But let's say you're making $100,000, whatever. Maybe you take home 70, 75, 70.
Right, but then you're spending an additional 30% more on everyday life.
Yeah.
But that's what I'm saying. So the problem is the perception of qualifying for this deal and affordability, where you think about if you rent a house in Toronto, let's say you make $100,000 a year, do the math, and your rent's $3,000 a month. Your utilities are this amount per month, or whatever the case is, groceries, food, all car insurance, if you have a car, maintaining the car. How much money are you really left with, and how much real money is actually going towards servicing that? So yeah, one minor flaw, one minor hiccup, hence a child being born, all of a sudden this additional $2,000 a month or $1,500 a month that you're spending, where's it coming from? Credit card, line of credit, because at that point you have no choice.
Yeah, savings have completely diminished. We've seen savings kind of increase during COVID, but after the rate hikes and everything that's happening in the market, people's savings have either diminished or been completely gone. They've had to tap into it to just stay afloat.
I've talked about this on our YouTube channel, is the M2 money supply. When you think about what the government and the Bank of
What's
Canada...
the money supply?
So basically that's how much money's sloshing around in the economy,
Circulation.
right? How much money's in people's accounts and savings, investments, like liquid cash, for example. It's the simplified. So during the money printing process, we'll call it that, where the government was writing stimulus checks and all this stuff, people's savings were up because they were locked in their homes. There was nowhere to spend it.
Yeah.
Now that is starting to dwindle away, and we're starting to see that curve offwards. And now that's also a good thing for the Bank of Canada because they're seeing that there's less money in the system, right? There's less money being spent. But to your point, people were able to save significantly better when they were getting handouts from the government. Even if you weren't getting handouts from the government, maybe you're at home, maybe you're tightening your belt, maybe you were self-employed. There's so many different parameters. But as soon as things opened up, especially in Toronto, like you drive around most of the areas, like you're looking and going, what crisis are we facing for some Canadians? Like, I'm not saying this in a good way or a bad way, but let's say you go for dinner for a special occasion, it's like they're slammed. All these restaurants are slammed. Everybody's traveling. We just came back from the airport. It was so busy. Like, what's going on?
So that means people are not worried about their mortgage.
But this comes down to the point. There's a certain cohort of people that are desperately worried about their mortgages because of the fact that they have a substantial mortgage. Maybe it's variable, maybe it's not. But then there's a big cohort of people that don't have any worries because if you have a small mortgage, even if your interest rate doubles, like I just talked to a person, a couple of times, a $200,000-$300,000 mortgage, yeah, the rate's going to go up. What's it going to cost them? An extra $100-$200 a month? They're like, okay, right? Like, and it's a lot of money for some, but not for others. So that's the thing. There's a lot of wealth in the system right now. So the impact on every Canadian is not the same. It's not unanimous across the
No,
board.
and I think that's what the majority of the problem is too, is because they're putting Canadians in one boat, right? Like they're saying, there's people that have money and have the ability to spend whatever whenever they want, and there's the some that can't. They can't afford to go out for dinner. They can't even afford to buy, a specific type of grocery to make for that night for dinner. So you'll see that there's a big gap, wealth gap in Canada, and the government's saying, well, you have to stop spending. But you try to tell people, or especially the ones that can afford to spend, to stop spending. I don't think you're not putting. it's very difficult to do that. Right?
How many millionaires were created over the last few? How many billionaires? I mean, I'm not saying that there's still a small percentage, obviously, but there's a lot of people that did well. There's a lot of people that were in very secure jobs. They were in the public sector.
Yeah.
They were not impacted. They were still working. No matter if there were recession hits, they're still going to get paid.
Yeah.
So like they're continuing on their life as normal. Yeah. Yes, there are going to be certain people that are going to tweak their spending patterns. Maybe I don't need to have, that particular alcohol. I can maybe move to that one. Or, you're going to look for different ways at the grocery store. Like you said, maybe I don't need this premium brand. I'm going to jump over. But for most people, they're still doing what they need to do. And like you said, if someone has that money, how do you influence a millionaire, a multimillionaire?
Yeah, and it doesn't even have to be. It doesn't even have to be a millionaire, right? Like you said, if there's people that have a very little mortgage, or if they bought that house back in 2000 and have no mortgage, you're kind of putting everyone in the same group, and I don't think it's fair. And these inflation numbers are, contribute to increased groceries, increased fuel that we've seen just in July. It's just been astronomical at the fuel tanks to fuel up a vehicle.
We were just in Calgary. A quick side note. 2 cab drivers that we were working with were previously in Ontario 12, 15 years ago.
Yeah.
And that's 12, 15 years ago, right? And some of them just came over from other parts of the province. So you're running into people at random in Calgary while you're there. It's like, oh yeah, I lived in Kingston, or yeah, I moved to Calgary. I had a ticket back to Toronto, and I just never came back, and I just stayed here in Banff, for example. So it's interesting, to go out there and actually see the dynamics versus hearing about it. But when you're actually out there listening to people's stories and why they came out, because you asked the question. I'm in that industry.
Yeah.
What made you leave? He's like, I couldn't take it anymore. It was getting too expensive. And I'm like, if you thought it was expensive 12 years ago,
newsflash.
what do you think is happening right now? And when we sat with some individuals and we were talking about this, we were shocking some of the realtors that were seasoned in Calgary. Like it's a completely different ball game, and they're just like, how much are you guys paying for this? And
even just closing costs alone on a purchase in Calgary is night and day from what we see here in Ontario.
No land transfer
tax, just legal fees, and
if people have more questions to tell you and ask you, where can they reach you?
So as we wrap up the episode, if you do want to get in touch with InTouch Mortgage Solutions, you can follow us on social media. You can follow us on Instagram at @A_Venuto. You can follow us on YouTube. Make sure you subscribe to the channel at InTouch Mortgages. And obviously you can send us an email or visit our website at intouchmortgagesolutions.com. And we'll wrap up the episode. Yeah, no, Claudio's one of the very few that doesn't have social media.
I was going to say you can reach us on Instagram, but you have your handle, and we have the InTouch page as well.
We have the InTouch. They have the InTouch page as well at InTouch Mortgage Solutions. And
See you later.
We'll see you later. Thanks for watching.
Take care.